The Federal Reserve just made a move that will directly affect your savings account, your mortgage, and your retirement. And most people have no idea what to do next. Stay with me, because in the next 12 minutes, I'm going to give you the exact playbook. Okay, let's get right into it. The Federal Reserve just announced a change to interest rates. Now, whether they raised them, lowered them, or held steady, it always creates winners and losers. The question is, which one are you going to be? Before I give you the three-move strategy I personally use when rates shift, and I will give you all three in detail, you need to understand what's actually happening here, because most financial content online gets this completely backwards. Here's the simple truth. Interest rates are the single most powerful lever in the entire economy. When they move, literally everything reprices, from your car loan to the stock market to the house you're renting or trying to buy. Hold on, I need to tell you the single biggest mistake people make when rates change, because if you make this mistake, nothing else I say today will help you. The mistake is doing nothing. Seriously. Most people hear interest rates changed, they feel overwhelmed, and they close the app and go back to whatever they were doing. But here's the brutal reality. Inflation doesn't care about your comfort level. The bank isn't going to call you with better options. Your money is losing or gaining power right now, whether you engage or not. The people who build real wealth aren't smarter than you. They just don't freeze up when the financial landscape shifts. They have a system. Today, I'm giving you that system. I promise move number 1 is coming in less than 2 minutes. But you need this context first, because otherwise the strategy won't make sense. Think of the Federal Reserve as the DJ of the economy. Their main tool? The federal funds rate, the interest rate at which banks lend money to each other overnight. When the Fed raises this rate, borrowing becomes more expensive for banks. They pass that cost on to you in the form of higher mortgage rates, higher credit card APR, higher car loan rates. When the Fed lowers this rate, the opposite happens. Borrowing gets cheaper, money flows more freely, businesses invest more, and people spend more. But, and this is critical, it also typically pushes inflation higher over time. So here's the eternal tension. Low rates equals cheaper debt, but eroding savings. High rates equals better savings returns, but expensive debt. The smart move is knowing which environment we're in and positioning accordingly. Let me show you exactly how. All right. Move number 1, audit your debt right now, tonight, not next week. Here's why this is always your first move, regardless of whether rates went up or down. When rates change, the cost of every dollar you owe changes too. And most people have no idea what rate they're actually paying on their debt. I want you to pull out a piece of paper or open your notes app right now and write down every single debt you have: your mortgage, your car loan, your student loans, your credit cards. Write down the balance and the interest rate for each one. Now here's where it gets interesting. If rates went down, any variable rate debt you have should also be adjusting lower. But you need to verify this. Your credit card company is not going to call you to announce your rate dropped. You have to check. If rates went up, this is the danger zone, especially for adjustable rate mortgages, ARMs, and variable rate credit cards. If you have an ARM, you need to calculate what your new payment looks like and decide now whether to refinance into a fixed rate before it goes higher. The golden rule: high interest variable debt in a rising rate environment is financial quicksand. The faster you pay it down or refinance it, the more money you keep. Credit card debt above 20% APR? That's an emergency. Treat it like one. And the move most people miss? Call your lender. Seriously, just call and ask, is there a better rate available for my profile right now? You'd be shocked how often the answer is yes. You just have to ask. Before move 2. Here's a number I need you to sit with for a second. Move number 2. Maximize what your savings earns you. Starting today. This is the move most people completely sleep on, and I genuinely don't understand why, because right now, depending on the rate environment, there is free money sitting on the table if you know where to look. Let's talk about your savings account first. If your money is sitting in a traditional big bank savings account, you are almost certainly earning somewhere between 0.01% and 0.5% annual interest. That's essentially nothing. You know what the rate of inflation typically is? Around 3 to 4%. So your money is losing real purchasing power every single month it sits in that account. Here's what you need to know. High yield savings accounts, HYSAs, offered by online banks can pay anywhere from 4% to 5.5% or more, depending on the rate environment. That's a difference of hundreds, sometimes thousands, of dollars per year on the same money, doing absolutely nothing different. Example: if you have $20,000 in savings, which is about the average American emergency fund, at 0.5% you earn $100 a year. At 5%, you earn $1,000 a year. That's $900 of free money you're leaving on the table every single year just because you haven't made a single phone call. Now, if rates just went down, here's the nuance. HISA rates will start to fall too, because they track the Fed rate. This means right now is actually the best time to lock in a certificate of deposit, a CD, at the current rate, before the rate drops further. Some CDs let you lock in today's rate for 12, 18, or 24 months. That's guaranteed money even as rates fall. If rates went up, HISAs become even more attractive, and you should move idle cash there immediately. But also consider Series 1 bonds if you haven't already. They're government-backed and their rate adjusts with inflation. Perfect hedge in a high-rate, high-inflation environment. Here's your checklist for Move 2. Number 1. Open a high-yield savings account if you don't have one. Number 2. Transfer any emergency fund or short-term savings there today. Number 3. If rates dropped, look at a short-term CD to lock in. Number 4. Keep enough in your regular checking to cover monthly expenses, but nothing more. And look, real quick, I just want to say something, because I get emails and comments all the time from people saying, Kendra, I feel like it's too late for me. I feel like everyone else figured this out years ago and I'm behind. I hear you, and I want you to know, the best financial move you can make is always the one you make today, not the one you should have made 5 years ago. Today, okay? So let's keep going. Move number 3. Position your investments for the rate environment. This is the big one. Now, I want to be clear. I'm not a licensed financial advisor. This is educational information, not personalized advice, and you should consult a professional for your specific situation. With that said, let me walk you through how I think about investing when rates shift. Let's break this into 2 scenarios: rising rate environment and falling rate environment. Scenario A, rising rates. When rates go up, bond prices go down. This is a fundamental inverse relationship. So if you're heavy in long-duration bonds, like 20 or 30-year treasuries, that part of your portfolio has likely taken a hit. The move here? Shorten your bond duration. Consider short-term treasuries, T-bills, or treasury money market funds, which actually benefit from rising rates. On the equity side, rising rates are generally tough on growth stocks, especially unprofitable tech companies, because their future earnings get discounted more heavily. But financial stocks, banks, insurance companies, often do better in rising rate environments because their lending margins improve. Real estate gets complex. Rising rates crush housing affordability, which slows the market. But certain REITs, real estate investment trusts, specifically those with short-term leases or inflation-linked contracts, can still perform well. Scenario B, falling rates. This is historically a very powerful environment for investors. When rates drop, bond prices rise, so longer duration bonds become attractive. Growth stocks tend to recover strongly as their future earnings get discounted less. Real estate often heats back up. In a falling rate environment, money market funds and HISAs will start paying less, which pushes investors towards stocks and bonds. This is called the reach for yield effect. It can create significant upward pressure on equities. The universal moves regardless of rate direction. First, make sure you're maxing out tax-advantaged accounts. 401k, IRA, HSA. The tax savings dwarf most investment decisions. Second, stay diversified. Rate environments change. A diversified portfolio navigates any environment better than a concentrated bet. Third, dollar cost average. Keep investing consistently. Trying to perfectly time the rate cycle is a game even professional fund managers lose at. The one thing I always come back to: don't let perfect be the enemy of good. The investor who put $200 a month into a simple S&P 500 index fund consistently for 30 years, regardless of rate environments, recessions, or crashes, almost always beat the person who tried to time it. Before I wrap up the 3 moves, I need to bust 3 myths I see all the time in the comments. Because if you believe any of these, it will completely undermine everything we just covered. Okay, here is your complete action plan. I want you to do these things in this order. This week, not someday, this week. Week 1, the money audit. Day 1 and 2. Write down every debt you have, balance and interest rate. Call each lender and ask about rate adjustments or refinancing options. Go to your bank's app or website and find your savings account, APY. If it's under 4%, you need to open a high-yield savings account. I'm not being dramatic. This is genuinely urgent. Day 3 and 4. Research high-yield savings accounts. Look for FDIC-insured options with competitive APY and no minimum balance requirements. Transfer your emergency fund there. Look at your 401k or IRA contribution rate. Are you getting the full employer match? If not, you are literally turning down free money. Day 5 through 7. Review your investment allocation. Does it match the current rate environment? If you're unsure, a simple 3-fund portfolio, total U.S. market, total international market, and a bond fund, is a battle-tested starting point that works in almost any environment. Look, the difference between people who build real financial security and people who don't isn't intelligence. It isn't even income, really. It's execution. They take the information and they act on it. So that's your homework. Now, because I know some of you are thinking ahead, let me give you a quick preview of what to watch for with the next rate decision. And I'll have a full video on this soon, so make sure you're subscribed so you don't miss it. The signals to watch before the next Fed meeting are the Consumer Price Index report, CPI, that's the main inflation indicator. The jobs report, specifically unemployment rate and wage growth, and the Fed chair's public statements and speeches, which often telegraph the next move weeks in advance. If CPI is still elevated and jobs are strong, the Fed will likely hold rates or raise further. If CPI is cooling and unemployment is ticking up, cuts are coming. Now you know what to watch. You're not just reacting to news anymore, you're reading it. Okay, let's recap your 3 moves before you go. Move 1. Audit your debt. Tonight. Know your rates, call your lenders, and eliminate high-interest variable debt as your top priority. Move 2. Optimize your savings. Move your emergency fund to a high-yield savings account. If rates just dropped, lock in a CD now. Move 3. Align your investments. Short-duration bonds in rising rate environments. Lean into growth in falling rate environments. Always max your tax-advantaged accounts first. Always stay diversified. That's it. 3 moves. You now know more about how to respond to rate changes than the majority of the population. If this video helped you, please hit the like button right now. Seriously, it takes 1 second and it helps this channel reach more people who need this information. Subscribe if you want to be the first to know when I cover the next rate decision. That video is coming soon, and I guarantee it will be worth your time. And leave me a comment below. What's your biggest financial concern right now? Debt, savings, or investing? I read every single comment, and I want to know where you're at. I'm Kendra. Take care of your money, because it will take care of you. I'll see you in the next one.